Now guys, I am going to discuss the agenda of this S&P 500 weekly technical analysis for the next week, that is from May 30th, which is Tuesday, through June 2nd, that will be Friday. And the first point of the agenda of this S&P 500 weekly technical analysis is the S&P 500 technical analysis on the weekly chart. Weekly chart means the big picture. So I will analyze the S&P 500 on the weekly chart. Technically, we will look into the technical indicators and accordingly I will tell you that what is happening on the weekly chart, if there is any trend change like bullish, bearish, or what we are expecting for the next few weeks or at least for 1 quarter. So weekly chart means the hawk-eye view, the big picture. The second point of the agenda of this S&P 500 weekly technical analysis is the FOMC, that is the Federal Open Market Committee minutes of the meeting that was published recently last week, and then the PCE and core PCE. This data was published yesterday and the data has confirmed that the inflation is holding and the inflation is not coming down. And then finally the recession, as the Federal Open Market Committee members has once again confirmed that there will be a recession, and because they are the policy makers, that is why whatever they are saying, or if they have reconfirmed the second time that there will be a recession, means there will be a recession. The third point of the agenda is the S&P 500 support and resistance levels. Now support and resistance levels means, for example, 4207. Yesterday I mentioned this thing very clearly, and also in my previous S&P 500 technical analysis, that 4207, okay, it's a heavy resistance. After 4207, if the S&P 500 is able to sustain above 4207, then only it can move towards 4227, else it will remain below 4207. Other than that, we have 4155. 4155, anything above 4155 means bullish, anything below 4155 means bearish. Then we have 4127, and here we have 4110, 4100 and up to 4035. So these were the support and resistance levels that I mentioned in my previous S&P 500 technical analysis. Similarly, I will give you the support and resistance levels for the coming week for the S&P 500. Then the fourth point of the agenda of this S&P 500 weekly technical analysis is the impact of US debt default on the US stock market and also on the global stock market, and not just on the stock markets but also on the US economy and the global economy. Because as of now, historically, US has never ever defaulted on its debt, but this time the situation, okay, it is different. That is why everyone means the market movers, the market manipulators, whether they are big or whether they are small, means everyone is preparing for all of these scenarios. Okay, so I'm going to discuss all of these scenarios in detail so that you can prepare yourself accordingly, that if the US defaults, then what is going to happen, how the things are going to move, how the stock market is going to move, and if the US doesn't default, then what will happen to the stock market, right? So I will discuss these scenarios, and this is the very important part, or this is the most important part of this S&P 500 technical analysis. Because if the US defaults, in that case you can't imagine what can happen. Now comes the fifth point of the agenda of this S&P 500 weekly technical analysis, and here it is about the S&P 500 technical analysis on the daily chart. Now this was the weekly chart. Weekly chart means the hawk-eye view, the big picture. The daily chart means that in the short term, like for a week or for 2 weeks, what is going to happen or what is happening in the S&P 500. Recently you have seen, or yesterday you have seen, that it moved up heavily, right? And you might be thinking that this is bullish or this is going bullish. Not exactly. Other than that, this is the upward movement. This is the green candle, not the upward movement, but this is the green candle. The green candle has now made enough room or more than enough room in the bear side, in the bearish side. This means that if there comes heavy fall like 5%, 10%, 12%, that much of heavy fall is allowed and the technicals will not saturate. If there would have been a red candle, in that case definitely just after one candle the technicals would have been saturated, and then on either on Tuesday or on Wednesday we would have expected the reversal, a bullish reversal. But now because of the formation of the green candle, now the market manipulators, the market movers, they have created more than enough room in the bearish side so that a fall up to 10%, 12% can be easily accommodated. So that is what I'm going to discuss in the fifth point of the agenda. Now comes the sixth point of the agenda of this S&P 500 weekly technical analysis, and this the last point of the agenda is the S&P 500 probable movement from May 30th, that is Tuesday, through June 2nd, that will be Friday. So I will tell you that what is probably going to happen in the S&P 500 on Tuesday, then on Wednesday, then Thursday, and then on Friday. So I will tell you that what is going to happen in the S&P 500 and also how it is going to happen in the S&P 500 and also why it is going to happen in the S&P 500 in that particular manner. So guys, if you have not yet subscribed to my YouTube channel, then please subscribe to my YouTube channel and hit the bell icon. Now guys, I am going to begin with the first point of the agenda of this S&P 500 weekly technical analysis, and now I will do the technical analysis of the S&P 500 on the weekly chart. So let's move on to the weekly chart. Now guys, this is the weekly chart. Let me write it down, W as in weekly chart. And here I'm going to discuss the first point of the agenda, that is the S&P 500 technical analysis on the weekly chart. Weekly chart means that the one candle represents 1 week, not 1 hour or 1 day. One candle means 1 week. Now on this the weekly chart, if you notice that almost like after 1 year, not almost but after 1 year or more than 1 year, finally we have seen this kind of picture. What kind of picture? That the S&P 500 on the weekly chart gave 2 consecutive closings above the Ichimoku cloud in the bullish side, right, in the bull side. This is clearly seen here. Now other than that, if you look into the candle itself, okay, so let's first analyze the candle as usual. If you look into this, the candle, then it's a bullish hammer. What? It's a bullish hammer. And what it indicates? The candle indicates a bullish movement or the bullish sentiments, as simple as that, right? So we have seen that through the candle, bullish sentiments or there's a bullish movement, okay, it is there or it is expected. First comes the Bollinger Bands. This is the upper band of the Bollinger Band. This is the median of the Bollinger Band. Because the S&P 500 has closed on the weekly chart in between the upper band of the Bollinger Band and the median of the Bollinger Band, this means that the S&P 500 on the weekly chart is bullish through the Bollinger Bands. Now comes the second technical indicator, and that is the Ichimoku cloud. Because the S&P 500 has closed above the Ichimoku cloud, this means that the S&P 500 is clearly bullish through the Ichimoku cloud on the weekly chart. Now comes the moving averages. Moving averages means EMA, exponential moving averages. Now there is a clear fan out in the moving averages. Clear fan out means the clear bullish fan out in the moving averages. Other than that, the S&P 500 on the weekly chart has closed above all of these the moving averages. This means that the S&P 500 is clearly bullish through the moving averages on the weekly chart. Clear? Now let's see what other technical indicators are saying. And if you notice that the MACD is clearly more than the signal. This means, and both are positive, this means that the S&P 500 is clearly bullish through the MACD. MACD means the moving average convergence divergence. Now comes the next technical indicator, and that is the stochastic RSI. Now if you look into the stochastic RSI, the K channel is more than the D channel, and also the K channel is above 90. Okay, this means that the S&P 500 is clearly bullish through the stochastic RSI. And remember that the change in the stochastic RSI, this change was brought into the picture by yesterday, means the candle that was formed yesterday, or the bullish movement, heavy bullish movement that we have seen yesterday in the entire stock market. Otherwise it was going bearish, right? So this is what we have seen. Other than that, the volatility is increasing and all other technical indicators are normal. Now what it means? This means that the S&P 500 is clearly bullish through the moving averages, that is the EMA. S&P 500 is clearly bullish through the Ichimoku cloud. Then S&P 500 is clearly bullish through the Bollinger Bands. Then the S&P 500 is clearly bullish through the MACD. Then the S&P 500 is clearly bullish through the stochastic RSI. This means that the S&P 500 is 100% absolute bullish on the weekly chart. But the most important part is that both of these, the MACD, moving average convergence divergence, and the stochastic RSI, both are now aligned bullish on the weekly chart of the S&P 500, and they are further expected to bring bullishness. However, there are some constraints about this, the bullish movement, and that is what I'm going to discuss in the FOMC minutes of the meeting and the US debt default and these things. But the most important part was that yesterday the bullish movement that was seen in the S&P 500 and in the entire stock market, it was half through the technicals, or it was partially technical and partially manipulated, right? So this was the combination of the manipulation as well as the technicals. So guys, once again, if you have not yet subscribed to my YouTube channel, then please subscribe to my YouTube channel and hit the bell icon. And if you are looking for the daily updates and the daily analysis of the S&P 500 from Monday through Friday, then you can join my Patreon community. I have given the link in the description of the video and also in the comment section. Now guys, I am going to discuss the second point of the agenda of this S&P 500 weekly technical analysis. And the second point of the agenda is the FOMC minutes of the meetings, then the PCE and the core PCE, and then the recession. Okay, so this is what I'm going to discuss here in the second point of the agenda, and I will begin with the FOMC. Now the question is that why the FOMC minutes of the meeting, or this the Federal Open Market Committee minutes of the meeting. Okay, it is very important, and everyone, okay, these are market movers and the market manipulators, they consider this the minutes of the meetings, okay, and whatever is mentioned there, okay, in that the document, okay, in this the minutes of the meetings, right? Now in order to access the minutes of the meetings, you need to visit the Federal Reserve website. When you visit the Federal Reserve website, then Home Monetary Policy Federal Open Market Committee, then you will see that for the month of May, this was the press conference and minutes, okay, minutes of the meetings. Now it was released on May 24th at 2 p.m. Eastern Time, US and Canada. Now the very first thing that I want to tell you is, this is the staff economic outlook. Staff means the committee members. The economic forecast prepared by the staff for the May FOMC meeting continued to assume that the effects of the expected further tightening in bank credit conditions amid already tight financial conditions would lead to a mild recession starting later this year. And this is the same statement, same line, and this was the same thing, same line, same statement that we have seen in the meeting that was there in the month of March. There was no meeting in the month of April, right? So in the month of March, this was the same thing. In the month of May, the same thing. This means that the recession is confirmed, number one, okay, this is clear. Then followed by a moderately paced recovery. Okay, so after the recession, then there will be, some recovery, okay, at this the moderate pace. Now the real GDP was projected to decelerate over the next 2 quarters before declining modestly in both the fourth quarter of this year and the first quarter of the next year. This means that if you have subscribed to my channel at least for last few weeks, then I've clearly mentioned this thing, that the GDP is declining. Okay, although the number is positive, but the GDP is declining, and that is the real problem. And that indicates, the GDP data indicates that there will be a further decline in the GDP. Now, the real GDP growth over 2024 and year 2025 was projected to be below, I repeat, below the staff's estimate of potential output growth. This means that the recession that is going to begin this year will be there at least until 2025. Then the unemployment rate was forecast to increase this year, and then to peak next year, and then to start declining gradually in 2025. Means the companies, they are going to fire more employees. People are going to lose the jobs. Now the other important part, that the market participants broadly expected a 25 basis point rate increase at the May meeting and blah blah blah, and saw the resulting rate as the likely peak for the current tightening cycle. Now this has indicated that most likely the Feds have reached to the point where there will not be any more rate hikes. Rather there will be, there's the rate pause, and the same we have seen through all of these the news channels. But the question was that, was this the only news? No, they did not tell you one more critical and the important thing. However, respondents still assigned a substantial probability that the peak rate may turn out to be above 5.25%. Right? No one has told you this thing, that the FOMC, that in the minutes of the meeting, that the respondents means these, the Federal Open Market Committee members, they have still assigned a substantial probability that the peak rate may turn out to be above 5.25%, because still there are chances that the Federal Reserve can increase the rate hike by another 25 bps, at least by 25 bps, because they have still assigned a substantial probability that the peak rate may turn out to be above 5.25%. The day these the Federal Open Market Committee members, that's okay, when they say that now there is no more probability, no more the peak rate, okay, above this particular mark, and this is the mark, that's it, then only we will say, okay, finally now the Feds are done and now there will not be any more rate hike. But now it is clear that the probability, but now it is clear that yes, Feds are still accepting the fact that if needed, then they can go for more than 5.25%. And if you notice, this was the same thing that I have given to my community members on May 24th itself. I've analyzed the FOMC minutes of the meeting and I told them that, see, this is the real picture. Do not trust what these are market manipulators, okay, and they are supported these, the news channels are saying, okay, but this is what is the summary, okay, what is the outcome of that, the Federal Open Market Committee minutes of the meetings. Now let's talk about the PCE and the core PCE, right? So PCE, core PCE, PPI, CPI, core CPI, okay, these are the important, this the data, okay, that these the Feds they consider, okay, when they work on the monetary policies, right? Because they are the policy makers. Now the PCE and the core PCE data that was published yesterday on Friday, if you notice that the last month, okay, this the PCE data, it was 0.3%, okay, there was an increase of the 0.3%. This time also the Wall Street was anticipating a 0.3%, okay, this, however the actual number was 0.4%, that the core PCE has increased by 0.4% more than what it was previous month and more than what was anticipated by the Wall Street. This means that the inflation is moving up, inflation is holding, inflation is not coming down, inflation is holding. That is the meaning of this, the PCE and the core PCE. So this, the PCE or the personal consumption expenditure data, okay, this is very, very important data. Now other than that, there was one more data that was published, that was the personal spending, that how the people are spending, whether the people are still spending or not. So last month it was 0.1%. This time the Wall Street has expected 0.4%. Means the Wall Street was also aware of this, the situation, that yes, the personal consumption, the personal spending is increasing. But surprisingly, there's, okay, the data, okay, that was published yesterday, it said that the personal spending has grown by 0.8%. Means people are spending more. Okay, either they are forced to spend more or they want to spend more, but they are spending more than what they were spending in the month of means in the previous month, and also what was anticipated by the Wall Street. What it means, PCE data, core PCE data, personal spending, all of this, the data has confirmed that the inflation is holding. Inflation is holding, inflation is not coming down. That is why we have seen in the FOMC minutes of the meeting that the committee members are still saying that yes, the 5.25%, this, the 5.25% terminal rate or 5.25%, okay, this is not the peak. This is not the peak. This can change, and if needed, the Feds can raise the interest rates. Now comes the recession. Because the Federal Open Market Committee members have confirmed the recession, this means that the recession will be there, no doubt about that. Now the question is that when actually the recession is going to begin. Okay, number one, and how severe the recession will be, number two. So I will answer these two questions when I will discuss the US debt default. Okay, because the recession, when it is going to begin and how severe it will be, it is directly influenced by the US debt default, means whether the US will default on its debt or not, as simple as that, right? But there is one more thing that I want to show you here. Okay, that is technically okay. And if you have subscribed to my channel for at least like 5 or 6 months, then I have told you that as of now the inflation, see, this is the headline inflation. Okay, this is the data, and this is the ticker is USIRYY. Okay, you can also add this ticker, okay, in your chart, USIRYY. And if you notice that the inflation is trading at its absolute bottom for like 6 to 7 months, absolute bottom, and now it has reached to the historical levels, although it is 4.9%, okay, but technically this is trading at the absolute saturated bottom. There is no, this means a bullish reversal. Technically, again, technically a bullish reversal must be there, a bullish reversal must come. And now the good thing is that whenever the bullish reversal comes in this the inflation, okay, this is expected to be good, at least like 10 to 15%, okay, something around 10 to 15%, or it can be even more than that, because yesterday we have seen that the PCE or the core PCE, okay, it was even more than what was anticipated by this the Wall Street, okay, from 0.3% to 0.4%. And that was the reason why we have seen a very heavy bullish movement in the entire stock market, because now the market manipulators are very much afraid. They're afraid on that the particular line where in the FOMC minutes of the meeting, in that particular line, the Federal Open Market Committee members have said that there is still a probability that the Federal Reserve can raise the interest rates beyond 5.25% if needed, because things are uncertain. That is why yesterday a very heavy movement, part technical, part manipulated, that was there, because they were afraid that now there will be a potential rate hike. Also they were afraid that now the US may default. That is why they have pushed it in the opposite direction, so that a message can be conveyed to everyone, to all of the retail traders, that see, everything is good, go buy, it is bullish market and everything, means there is no need to worry about, everything is good. And that was further supported by these the news channels that actually run the propaganda of these the market manipulators. But in actual, what they are doing, they are collecting the shorts, and also the put options, right? This is actually a trap and nothing else. Anyways guys, if you have not yet subscribed to my YouTube channel, then please subscribe to my YouTube channel and hit the bell icon. And if you are looking for these the daily updates, the daily analysis of the S&P 500 from Monday through Friday, then you can join my Patreon community. I have given the link in the description of the video and also in the comment section. Now guys, I am going to discuss the third point of the agenda of this S&P 500 technical analysis. And the third point of the agenda is the S&P 500 support and resistance levels for the next week. Now for this, the support and resistance levels, as of now, the immediate resistance that the S&P 500 is going to face is the 4207. It is 4207. That is the immediate resistance. After 4207, then we have 4227, right? And then we have 4265, and then finally we have 4291. After 4291, approximately around 4300 or 4305, we have 61.8% of the Fibonacci retracement level on the monthly and the quarterly chart of the S&P 500, right? So this the 4155 here, 4155, this was the 50% of the Fibonacci retracement level on the monthly and the quarterly chart. But the 61.8% is approximately 4300 or 4305, right? So as of now, let's keep it up to 4291 or 4300, and this is the same thing that I mentioned okay, many times, okay, in last few weeks and last few months, that as of now, whatever is going to happen in the S&P 500 for any known or unknown reason, whether through technicals or through manipulation or through any logical movement or through any illogical movement, the upward movement is expected to be a maximum up to 4,300, because that is the 61.8%. Okay, secondly, now we have the recession. This means that a bullish movement, okay, it is just fake. A bullish movement is fake, right? Whatever bullish movement is coming into the picture, that is, or that will be a maximum up to 4291 or 4,300, and that's it, right? Then it will fall, and it is not actually the 4,300, but it is the 4227. Okay, so we can expect that yes, any upward movement for now will be up to 4227. Okay, as such, beyond 4227, okay, it is not expected or not much expected. And in a worst case scenario, okay, or in a heavily or highly manipulated scenario through any illogical movement, up to 4,300 maximum done. Okay, these are the resistance levels. Now the next comes the support level. So the immediate support that the S&P 500 is going to see, okay, it will be at 4195. So 4195 is not the calculated support level. No, it was what was the high of the S&P 500 this year. Okay, that is why this is still there in the picture. Then the calculated support level actually is the 4185. That is the calculated support level, right? So 4185. So whenever it try to move up, and if it is trading below 4185, then it will struggle around 4185. If it is trading above 4185, and whenever it comes down, then it will try to hold above 4185. Okay, this is how it works. Then comes the 4155. 4155 is very strong support as well as resistance level, because the S&P 500 is trading above 4155. This means that 4155 is now going to act as very strong support level, right? And also remember that yesterday the open of the S&P 500 was at 4156. And even before the open of the S&P 500, I mentioned this thing that when the stock market opens, when the S&P 500 opens, and when it opens in the bull side, and if it opens above 5155, then this means the stock market or the S&P 500 has gained the initial traction, and now all it needs to do is to sustain above 4155, and then it is free to move towards 4185 or 4195. And if it is able to breach and sustain above 4185.95, then towards 4207, right? So because it opened above 4156, just above 4155, that was the reason it has gained the initial bullish traction. Other than that, it was also manipulated because of the formation of the three bearish candles, okay, back to back. Yesterday, Friday, technically it was supposed to come down, okay, a little, and it was supposed to breach 4155. It was supposed to come around 4150, and then only it was allowed to, get a reversal and to move, where, or to move or to go wherever it want to move or it want to go, right? But it did not do that, okay, and rather, okay, the open was the low and it moved up, right? Anyways, we are talking about these support and resistance levels for the S&P 500. Now, after 4155, we have 4127, very good support, very strong support. Then we have 4110, again a very good support. Then we have 4091, okay. Then we have 4065, okay. Then comes 4035, and yes, we must also consider, many other these are support levels. Then we have 4000, then 3985, 3957, 3937, 3907. Yes, 3907 is strong, along with 3937, okay. Then comes 3884, 3840. This is very strong, 3840, okay. Then we have 3790, okay. And after 3790, we have 3765, okay, approximately. Now question is that why we are keeping the bull side up to 4300 or this 4227, but in the bearish side, okay, we are talking about 3700 or 3800. Why? The reason is that if you measure, okay, from the close to around this the 3,3884 or 3790, then you will see that it is approximately 10%. Okay, and because next week will be heavily volatile, highly volatile, okay, because of this the debt ceiling. Okay, there is no concrete, this is the result on this the debt ceiling. And if there comes, okay, this kind of news, or if the picture is clear that now the US is going to default, or now probably or most likely the US is going to default on its debt, okay, then 10 to 12% of fall within a day, within 2 days is okay, acceptable, and will be normal. Now guys, if you want to join my Patreon community, then let me help you understand that how you can join my Patreon community and what you are going to get when you join my Patreon community. So there are these the two things. The number one thing, that you will get the daily analysis, the daily updates of the S&P 500, and you will come to know even before the things happen in the stock market, even before the things happen in the S&P 500, that what is going to happen and how it is going to happen in the S&P 500 and in the entire stock market. Other than that, you will also get the stock market opportunities, the US stock market opportunities in the premium stocks. Premium stocks means the top 30 constituents, the blue chips of the Dow Jones, or the top 50 companies of the S&P 500. Now, in order to join my Patreon community, you need to visit the link I have provided in the description of the video and also in the comment section. Then you will see that this is my Patreon page, and there are these the 3 levels. The first one and the second one both are the daily S&P 500 updates, the daily analysis of the S&P 500. But the first one is only for non-US Canada residents. The second one, this one is for US and Canada residents only, right? That's the only difference. When you opt for this or any of these, then you will get the daily analysis, the daily updates of the S&P 500 from Monday through Friday, each and everything, pre-market update before the open of the stock market, and the final update before the closing of the stock market, first, second, third updates, the analysis of the important data, each and everything. And this the third one is the market opportunities and daily update. This is open to all irrespective of your geographical location, and this means that if you opt for this one, and if you opt for this one, or if you subscribe for this one, then you will get the daily analysis, the daily updates of the S&P 500 from Monday through Friday, as well as the stock market opportunities in the premium stocks, minimum 5 to 10 opportunities every week, minimum 5 to 10, or up to 50 stock market opportunities in the premium stocks every month in the US stock market. And guys, if you notice that many people have joined my community for last many days, weeks, months, and it's going to be almost about 1 year. And if you also want to join my Patreon community, and if you also want to get these the daily updates, the daily analysis from Monday through Friday, then I've given the link in the description of the video and also in the comment section. Now guys, I am going to discuss the 4th point of the agenda of this S&P 500 weekly technical analysis. And this the 4th point of the agenda is the US debt default. Now this is very important. Okay, so let's first understand that what is this the debt ceiling, okay, or this the debt default, or what is in general, okay, what is this the debt default. Now let's say you have taken a loan, for example a personal loan. Okay, you have taken a personal loan from a bank. Every month you are under obligation that you must repay the money, okay, in the installments to the bank. Now as long as you are making your payments timely to the bank, everything is good, right? But as soon as you default, means you fail to repay your monthly installment, on a particular date. See, bank has fixed a particular date, that see this is the date, and on this particular date you must repay your monthly installment. Now the day you fail to repay the monthly installment on a particular date, in that case this will be considered as a default. Okay, but this does not mean that you do not have any intentions to repay. Means you can repay, but you might need more time, okay, or there are so many factors. Now the concept of debt ceiling, this was brought in by Congress, right, as usual. So we see they are the policy makers, okay, they decide what to do, how to do, okay, when to do, why to do, etc. Okay, so they brought in this concept, and this concept, rather than solving the problems, this concept itself become a problem. It has become a problem because see, we have the president, the power is distributed between these two, president and the Congress, and now this, the power is evenly distributed, right? So president is allowed to spend the money and to collect the taxes. Taxes means the earnings, okay, and spending the money means the expenditure, earnings and the expenditure. President is allowed to do these things, okay. However, he must get an approval from the Congress on the same, right? Now, because see, just like the US, okay, almost all other countries, there are only a few or a very few countries, okay, that are doing well. Otherwise this is the same problem, okay, in all of the countries, that your expenditure is more than your earnings, okay. Your expenditure is more than your earning. That is why this, okay, that is why the people who are in the power, okay, they borrow the money from the central bank. In this case, it is the Federal Reserve. They borrow the money from the Federal Reserve, okay. Federal Reserve, okay, issue the bonds. People buy the bonds, they give the money to the Federal Reserve. Federal Reserve pass this money to the Congress, okay, president, okay. This is how it works, okay. Anyways, so your expenditure is more than the earnings. Now, in order to match this thing, expenditure equal to earnings, okay, you need to borrow the money. And how the president is going to borrow the money? The president will borrow the money from the Congress. It is the Congress that is okay, that is responsible, or who is responsible, okay, to for giving, okay, this approval to the president, okay, yes, okay, that we have given you the approval that now you can use this much of money, okay, you can borrow, this much of money, etc. And this is actually where the problem is, okay. Now we have the two parties, okay, political parties. We have the Democrats and we have the Republicans, okay. Now the Democrats, so the president, okay, he's a Democrat, and the Congress, okay, see, Congress is a house, okay. In the house, the majority, okay, it is held by the Republicans, right? And now, because the power is evenly distributed between these two, president and the Congress, okay, and both of these are ruled by two different parties, or the majority, okay, these are two different parties, okay. Now that is actually the problem, that the Republicans are saying that we have some demands, and they are asking the president, okay, and the Democrats to agree to those demands, and then only they will allow to raise the debt ceiling, that is for now, that is somewhere around, I think, $39 trillion of debt. 39, see, this is the rough number, okay. It can be more or less, but this is somewhere, this is the total debt on the US, okay. And if you think that it is only the US, no, okay, almost every other country except a very few, okay, almost every other country in the world, okay, they are dealing with their own debt, right? So now this is this is the problem, that the Republicans are saying that agree to our demands, and then we will approve this excess funds, okay, or we will allow you to borrow, okay, this is the money, and we will okay, then the debt ceiling can be raised, and in that case the US will not default. Now let's say that the government has issued the bonds, and everyone, including the individuals, institutions, okay, and even the foreign investors, the foreign governments, they have bought the bonds, okay. Now through the bonds, the US government has promised that the US government will give this much percentage of interest, okay, 4 to 5%, 7% interest to the investors who have actually given the money to the government. So the problem is that the current debt ceiling, US has hit its current debt ceiling, has hit its borrowing limit. Now the president, okay, and the government cannot borrow anymore until and unless the Congress gives its approval to raise the limit from, let's say it was $40 trillion, and if the Congress say, okay, now we are raising this to like $45 trillion. So until and unless the Congress gives the approval to raise the debt ceiling, this means that the government cannot borrow anymore. And because the government cannot borrow anymore and the government has very limited money, okay, and government has to distribute the money, okay, in like social security, pension funds, okay, this thing, that thing, okay, XYZ, and many other things. This is very, very complex. Okay, so now, so what will happen now? What will happen that the government who has promised to these the investors that, see, on a particular date, let's say on June 1st, okay, we will repay you this the money along with the interest, or we will pay you the interest for these the bonds. Okay, now the government will not be able to pay that interest or the money to the investors who have lent the money to the government based on the assurance that the government is giving us the bond and the government will pay us the interest on this the money, okay, on this the sum, and then finally, okay, on the at this the maturity we will get the money. This is what is considered as the default, just like a loan. So the government has taken a loan from you, you are expecting the repayments for the loan. So far everything is good. When the government says that no, because of this the debt ceiling reason, we cannot borrow more, we have very limited money, we have to invest money, okay, in the defense, okay, in the pension funds, social security, and XYZ, okay, and many other things. So we cannot repay you the money, okay, at this time, but yes, in near future we will repay you the money, or after some time we will repay you the money, but it has defaulted. Okay, now the default is there. Now it doesn't matter when the government is actually giving you the interest and the money, okay, whether it is after 1 week or whether it is after 1 year, but the default is default. Now let's say that the government has defaulted, okay, on its debt, okay, on the payments. Okay, so what will be the implications? As of now, if you have heard that there are these ratings, AAA rating, okay, AA rating, plus minus, then A, plus minus, then B, or triple B, I guess, plus minus, then double B, etc, etc. Okay, so we have these ratings. So far, as of now, the US government is enjoying AAA rating. AAA means we can trust. Okay, we can trust the system, we can trust the government, we can trust the Federal Reserve, we can trust the dollar. Okay, it is enjoying the AAA rating. Okay, now when there comes a default, then what will happen? Then based on the the intensity of the default, okay, like how the US government is planning to repay the money and to whom it is going to repay the money at first, okay, whether it will repay the money to the foreign governments, okay, or to the foreign institutions, or to the individuals, okay, or it will not repay the money to any of them, rather it is going to repay the money or it is going to use the money, okay, in the pension funds, okay, or in some other fund, social security, etc. Okay, so it depends, okay, what kind of default is there. Okay, now, but this thing is clear that through any kind of default, the rating will be downgraded from AAA to a minimum of, okay, not to a minimum, sorry, not to a minimum, because minimum can be triple B or B, okay, B, okay, this thing. So the economist, okay, or who have studied the economy, they understand this thing very well, but definitely the rating, okay, it will be downgraded. Now let's say the rating has been downgraded from AAA to AA. So what will happen? You need to understand that whenever you buy the bonds, okay, then what you do, you look into the rate of return, the frequency, okay, but the most important part is that who is the issuer of the bond, okay, and what is the rating, rating of the bond issuer, right? If it is AAA, then yes, you can trust, means not actually blindly, but kind of blindly you can trust. This means that this particular institution or this particular government, okay, is means it can be trusted, and you will most likely, highly likely, 99% or 100% you will get your money back along with the interest. Okay, but because this is the institution is enjoying AAA rating, this means that this particular institution will give you, for example 4% interest, right? Now let's say there is another institution, this institution or this company is or the company has AA rating, AA minus rating. Okay, This means that it can be trusted, and there are like 95% chances that you can trust and you will get your money back and everything will go okay as per plan. And because the rating is less than okay this much, this means that now this institution, the second institution, must give more than what this institution is giving, let's say 5%, right? Now there comes one more institution. This institution is let's say it has like BB negative, okay, this the rating. This means that this is risky, like 80%, 70 to 80% chances that you will get your money back, okay, but there might be some problems, okay, or you should be ready to face some of these issues, okay. But still, because you are taking the risk, this means that now this the third institution must give the interest more than these two, let's say 7%, right? This is how it works. The more secure and okay, or this the highly rated institution will give you the less percentage of interest. For example, Microsoft, okay, if you go and buy the bonds of Microsoft, then Microsoft and Apple will give you the very less, okay, interest rates, maybe like 2%, maybe 1%, maybe 2.5%, okay, that's it, nothing more than that. But if you look for the companies like Tesla, then Tesla will give you an interest rate of 5%, 7%, because the reason is that the Microsoft and Apple, they enjoy AAA rating, okay, whereas Tesla enjoys only A minus, I guess, okay, or BB, okay, some means that kind of rating, right? So this is how it works. Now how it is going to impact, see, I am simply trying to help you understand the chronology, that how it works, okay, so that you can plan your trades, you can plan your future trades accordingly, and you can prepare yourself, right? Problem is that when the US defaults and its rating is downgraded from AAA to AA, okay, or to A, okay, I think it is means there are no chances that it is going beyond A, like into B, okay, that is not there, because in 2010 or 2011, when there was this the Obama administration, okay, the similar kind of situation was there at that time, and the Obama administration accepted the demands of the Republicans, okay, and the same thing that time, one of the agency has downgraded the rating from AAA to AA, okay, but that time the impact was not felt that much, and that time also the inflation was normal, okay. Now the inflation, the core inflation is 5.5%, right? Feds are raising the interest rates back to back heavily, right? Rise in the interest rates is putting the economy, okay, not putting, but actually has brought the economy into the recession, because that is the recession is confirmed. I have cleared that thing in the second point of the agenda of this S&P 500 Technical Analysis, that how the recession is, okay, it is now confirmed, okay. Now if the US defaults, if the rating is downgraded, then the US government, okay, or the government, simple, the government, okay, government means the Senate, okay, President, the Congress, okay, and the Federal Reserve, okay, the government, then the government has to pay more interest, government has to pay more interest on its bonds. That is the real problem. Overall this will be a perfect scenario, this will be a perfect scenario for the Great Recession. For the Great Recession, unemployment is high, inflation is high, and there is not enough money to support these the public schemes, okay, or the public, okay, and then your 401k, okay, means a lot of things, okay, and means so and so, right? Other than that, the value of dollar will decrease, okay, so the dollar will lose its value, the dominance of dollars, okay, it will further come down, means a lot of things that you can think of or that you cannot think of, it will be there, right, as such. So this is all about this, the debt default, that if the default happens, okay, then this is what is going to happen, and this is what we are expecting or anticipating. But one thing is very much clear. Now let's talk about the recession through the debt default. See, this thing is clear that the recession is there, confirmed by the Federal Reserve, that the recession will be there. Now there is no more doubt about that. Only an exceptional case can help or can save the economy from coming out of or from not entering into the recession, okay. That exceptional case will be if the Feds start to or start doing this the rate cuts. Means rate cuts, not like 25 bps 1 month and then wait for 2 or 3 months. No, every other month they must go for the rate cuts like 25 25 25 or 25 50. If they go for this, then yes, in that particular case we will say that a correction is there or correction was there and there will not be any recession. But so far the Federal Reserve has confirmed that no, there will be no rate cuts, and even the pause in the rate hikes, that is also cannot be considered at the moment. And yesterday the PCE data, the PCE and the core PCE data has further confirmed that the inflation is holding, and the inflation is holding. This means that the inflation is not coming down, and this means that the Feds must increase the interest rates in order to bring down the inflation. And within 1 day, just within 1 day, means on Friday itself, the chances. So earlier everyone was thinking that now there are only like 20 to 25% chances that the Feds will raise the interest rates. Within a day, those chances are now more than 60%. Within a day, more than 60%, right? This means that if there comes more data like the next inflation data and like CPI data, headline inflation and the core inflation, and if that comes more than anticipated or bullish reversal in the inflation, then what will happen? Then these 60% chances will be 100% confirmed that now the Feds are going to raise the interest rates, because the inflation is going bullish. It is not just holding, but it is going bullish. They will raise the interest rates, right? Now the role of the US debt default, in the recession. If the US default on its debt, in that case the recession will begin as early as June 1st, or June 5th. Yesterday there was a news that now the Treasury Secretary is saying that the government has funds up to June 5th. Means chances of defaulting are not there at least until June 5th. But as you know that the stock market reacts to any news or any event before it actually happens. This means that the stock market or the US stock market will not wait for June 1st or June 5th. It will react even means much before that, right? So the recession will begin, number one, from that date. Secondly, recession will be very severe. It will be of very severe nature. Means this will be the another worst recession or the great recession, and this will be there at least for 2 to 3 years, and its impact will be felt at least for next 5 years. And other than that, the recovery from the recession, it will be a time consuming process, that will further take. As of now, the Federal Reserve was anticipating that the recovery will be there, from the first or second half of 2025. But if this happens, this kind of situation is seeing the default, in that case the recovery will be there, from 2026 or 2027. Until then, just everything will slow down drastically. So that means the debt default, it will simply accelerate and make the things severe. That is one part. Now, if the US, means if these are policy makers, President and the Congress, both of these parties, if they agree to some terms and conditions, each other, and if they finally come to a conclusion that the US is not going to default on its debt, in that case what will happen? In that case, we need to see that whether any agency is downgrading the US from AAA to AA or not. Because similarly, something similar we have seen in 2010 and 2011, that one agency has downgraded. This time, if any of the agency downgrades the US from AAA to AA, then at the same time the inflation is very high. And this time there will be some impact. Means the recession that was supposed to begin in next 1 or 2 months or 3 months, that will begin like within a month or so, right? Now comes the third case, not third case, but the extension of this case, if the US doesn't default, and if the rating remains as is. In that case, what will happen? In that case, the recession, that was supposed to come, it will then come like in next 1 to 2 months, 1, 2 or 3 months. It will be there in the third quarter. So we are already in this. We are going to enter into this the third quarter. So it will be there anytime in the third quarter. And this the recession, it will be a mild recession, means as per means what the Federal Open Market Committee members have projected, that the recession will be there, and by 2025, the first or the second quarter of 2025, the entire economy and the stock market, okay, will come out of this the recession. So the recession will be there for like 15 months or 15 to 18 months. So guys, if you have not yet subscribed to my YouTube channel, then please subscribe to my YouTube channel and hit the bell icon. And if you want to get these the daily updates, the daily analysis of the S&P 500 from Monday through Friday, each and everything, and as well as the US stock market opportunities in the premium stocks, then you can join my Patreon community. I have given the link in the description of the video and also in the comment section. Now guys, I am going to discuss the fifth point of the agenda of this S&P 500 weekly technical analysis. And this the fifth point of the agenda is the S&P 500 technical analysis on the daily chart. This is the daily chart. Let me write it down. Daily chart, DS in daily chart. Daily chart means that the one candle represents one day, not 1 hour or 1 week. One candle means one day, right? So let's first examine the candle itself. If you look into the candle, the low of the candle was the open of the candle. And that was the same thing that I mentioned in my first update to my community members, that because the S&P 500 is trading above 4155, and also the so far, okay, after 1 hour, the open is equal to the low for the day. This means that this condition is saying that the S&P 500 and the stock market wants to remain bullish, and until and unless 4155 is breached, the S&P 500 has no chances to come down. This means that this candle where the open was the low has clearly indicated that there were the bullish sentiments. Other than that, the closing of the candle was near to the high of the candle. Okay, the closing of the candle was it was approximately not equal but near, because the high was the high was 4212 and the close was 4205. Okay, high of the candle. Okay, and also it is a very solid green candle. This indicates that there were bullish sentiments in the S&P 500, in the entire stock market by the time of closing on Friday. So this candle is simply representing or simply giving the bullish sentiments. What we have seen on this the weekly chart, same, the bullish sentiments. Bullish sentiments on the weekly chart, bullish sentiments on the daily chart through the candles, weekly candle and the daily candle. This means that overall the candles are giving the bullish sentiments to the S&P 500 as well as to this the entire US stock market, right? Now let's see what the technical indicators are saying on this the daily chart. Now if you notice that this is the upper band of the Bollinger Band, this is the median of the Bollinger Band. Because the S&P 500 is closing in between the upper band of the Bollinger Bands and the median of the Bollinger Band, this means that the S&P 500 is bullish through the Bollinger Band on the daily chart. Now comes the moving averages, the EM, exponential moving average. If you look into these the moving averages, then there is a clear fan out. What kind of fan out? Bullish fan out. Secondly, the closing of the S&P 500 was above all of these the moving averages. This means that the S&P 500 is bullish through the moving averages or through the EMAs on the daily chart. Now comes the this the Ichimoku cloud. So the S&P 500 is clearly moving and closing or has closed above the Ichimoku cloud. This means that the S&P 500 is clearly bullish through the Ichimoku cloud, right? Now comes some other technical indicators. MACD. Now because there was a very heavy bullish movement, because of that heavy bullish movement, the MACD has changed the direction. Okay, it was bearish, now it has turned bullish once again. Okay, so this was done willingly, because if the movement was up to like 4185 or so, or 4190, okay, in that case the MACD would have remained bearish. Okay, but it was willingly moved, it was pushed to close above 4200 so that the MACD can, okay, or it can change. This is what we call as the mark the close, okay, and this is what we have seen many times. For now, the MACD is more than the signal. Both MACD and the signal both are bullish. Okay, This means that through the MACD, S&P 500 is clearly bullish. Now comes the stochastic RSI, the same thing, the same situation. The K channel is more than the D channel. Stochastic RSI, this means that the S&P 500 is bullish through the stochastic RSI. If you look into the stochastic RSI, again the same thing. If the S&P 500 would have closed around 4185 or below 4195, okay, in that case definitely the stochastic RSI would have remained bearish, right? So it was, so this, the S&P 500 was pushed in a manner above 4200, so that both the S&P 500 and the stochastic RSI can change the direction, so that technically it can form a bullish condition, right? And anyways, all of the technical indicators are saying that things are normal and the volatility, it is increasing. So now what we have seen on the daily chart is that the S&P 500 is bullish through the Bollinger Bands. S&P 500 is bullish through the EMA moving averages. S&P 500 is bullish through the Ichimoku cloud. S&P 500 is bullish through the MACD moving average convergence divergence. S&P 500 is bullish through the stochastic RSI. Once again, both of these, the stochastic RSI and the MACD, both are now aligned bullish. This means that the direction and all of the technical indicators are also bullish. This means that now the S&P 500 on the daily chart is 100% absolute bullish, right? No, it is not. I will give you the reason in the next point of the agenda, that is the probable movement. Okay, I will discuss and I will show you the chart of the Dow Jones. Okay, that is why even though everything looks bullish, 100% absolute bullish, but the Dow Jones is telling us a different story. And guys, one more thing that I forgot to mention here, that these are the services that I offer, and I have given the link to my website, that is tradingsp500.com, in the description of the video and also in the comment section. And also in this, the program where I give the 30% returns in 1 year, I'm updating these the screenshots regularly, okay, whatever trades I am giving to my members, and also I am giving these the calculations here. So guys, once again, if you have not yet subscribed to my channel, then please subscribe to my channel and hit the bell icon. And if you want to join my Patreon community, then I've given the link in the description of the video and also in the comment section. Now guys, I am going to discuss the sixth and the last point of the agenda of this S&P 500 weekly technical analysis. So in this, the last point of the agenda, I will give you the probable movement of the S&P 500, that how the S&P 500 is going to move in the next week from May 30th, that is Tuesday, through June 2nd, that will be Friday. So what is going to happen in the S&P 500 and in the entire stock market on Tuesday, Wednesday, Thursday and Friday until June 2nd. So guys, because the next week, okay, it is very crucial, okay, very important week, okay. So you must remember, okay, a few things. Number one, so for now the date was June 1st, okay, and that by May 31st, these okay, these are two parties, okay, Republicans and Democrats, okay, they must agree to something, okay, and they must not allow the US to default on its debt, right? This is clear. Now yesterday, okay, there was a news, I do not know, okay, whether that is a confirmed news or not, okay, that now the Treasury Secretary is saying that we have time until June 5th. They have the time until the next week only, okay, and then only we will come to know, okay, whether the US will default on its debt or will not. And if it is not going to default, then whether some agencies are downgrading the rating of the US or not, okay. So I have already discussed these things in very detail in the previous point of the agenda, fifth point of the agenda of this S&P 500 weekly technical analysis, okay. The second thing is the recession. The recession is confirmed by the US Federal Reserve, okay. This means that now even if the market manipulators, if they say that there will be no recession, even if there comes, you know, some economist, okay, out from somewhere and says that there will be no recession, okay, so that will, does that all, whatever they are saying, that will be considered and will be seen as a lie, pure lie and nothing else, because now the policymakers themselves have accepted the fact and have confirmed that the recession will be there. This means that no other argument will be accepted from anyone until and unless the same policymakers, until and unless the government itself says that no, there will not be any recession, and we will go for this the rate cuts, and we will cut the rates aggressively. Okay, chances of happening this particular thing, rate cuts or aggressive rate cuts, it is less than 0.01%. Okay, but if this happens, then yes, then there will be no recession. Okay, then there will be the continuation of the bullish movement. Otherwise the recession is confirmed. So you should plan and you should prepare accordingly. And if you remember that in last few weeks, in through my the S&P 500 weekly technical analysis, and if you are my community member, okay, then almost every other day, okay, I mentioned this thing, that whatever bullish you are seeing, okay, this is the blessings in disguise. This is the blessings in disguise, because this is what is happening just before the recession. And every time when there comes a correction or a recession, then just before that there comes an illogical movement, illogical, that cannot be explained, that comes against the technicals, and like it is highly or heavily manipulated. Okay, this happens every time. Okay, this happens. This is why it is a blessing in disguise, because for those who are thinking, or the retail traders, okay, who are thinking that it is going bullish, everything is now fixed, okay, and these are market manipulators, they are spreading their propaganda, there's the propaganda through these the news channels, and telling everyone that no, everything is fixed, okay, and the entire stock market is going bullish. So their sole purpose is to accumulate the shorts, shorts, okay, or the put options. That's it, nothing else. This is the upward movement, this is the bullish movement for any known, unknown reason, through any logic or through like illogical, okay, these are the reasons. This is the movement, it is a blessing in disguise, because the market manipulators, they are accumulating the shorts and the puts, and you should also do what they are doing, because eventually they are the one who are going to win. Okay, and this is how it works every time. But when I say the collect short and puts, I mean that you should be prepared for 1 year. And if you are trading in the short term, or if you are an intraday trader, okay, or if you are a very short term trader, then you should trade, okay, as per the swings, or as per the movement, the daily movement, okay, of the stock market, right? So your strategy is defined based on whether you are a short term trader, intraday trader, or if you are a long term trader, or if you can wait for, or if you can plan for 1 year. Anyways, now comes the third point, okay, that you must consider. After the recession, the third point is the inflation. So when I say inflation, yesterday, sorry, not just yesterday, but before yesterday, okay, when the CPI data was published, okay, CPI and the core CPI data, that was the very first indication where we came to know that the inflation is holding. Okay, and I've cleared this picture that on that day itself, that the inflation is holding, and whatever the data is going to come, like PCE, etc., okay, again we are going to see the same thing, that the inflation is going to hold. So that was the very first indication. Now comes the PCE and the core PCE data. PCE and the core PCE data has further confirmed that the inflation is holding, not just holding, but this time, okay, even it gave a little bullish reversal. Means it was more than what we were anticipating earlier. Okay, not we, but actually the Wall Street, the big ones, okay, they were anticipating the inflation came more than that. Okay, this means that now the Feds have to rethink, and then within a day the probability was more than 60% that now the Feds can raise the interest rates once again in the month of June, okay, by 25 bps. Okay, so within like 1 day everything has changed. Inflation. Now comes the fourth point, and the fourth point is that bank. Yes, the banks. Okay, as of now there are some banks, okay, one or two that I know, but I do not want to name the banks, okay, because that may bring some controversy, okay, but because they are these the big banks. Okay, so as of now there are some banks, after this the recent rate hike of 25 bps, there are some banks, okay, one is the European bank, and one is not one but two are the American banks. Okay, so and there are some other small banks. So these banks are on the very thin line, okay, very very thin line. Okay, just one more rate hike and they will be gone. This further confirms, see, I'm not saying that that these banks cannot fail before the rate hike, they can fail even before the rate hike. Okay, but the next rate hike and very heavy pressure. Okay, this means that these the market manipulators, okay, they are spreading their propaganda through these the news websites, news channels, that see everything is good, everything is fixed. Okay, so this further confirms that no, nothing is fixed. Rather, things are getting more and more fragile, more and more fragile. Okay, and just one little this, one small thing, and then this the dominoes. Okay, just everything will then fall down. Okay, the dominoes effect. Now comes the fifth and the last point that you must remember, and it is the Dow Jones Industrial Average Index. Now, if you remember that in my previous point, okay, the fifth point of the agenda of this S&P 500 Technical Analysis, okay, we have seen that the S&P 500 was 100% absolute bullish on the daily chart. S&P 500 was 100% absolute bullish on the weekly chart. Okay, and then I said that no, it is not bullish. Okay, it is not clearly bullish. Why it is not clearly bullish? Because of the Dow Jones. Now let me tell you that why I have mentioned this thing, that why it was not clearly bullish. Okay, Dow Jones. See, as you know that the Dow Jones, okay, it is the face of the economy, and Dow Jones contains or consists of these 30 blue chip stocks. So now when you look into the picture, until yesterday, the Dow Jones was 100% absolute bearish. And it gave 2 consecutive closings below this, the Ichimoku cloud further confirmed. And now through the technical obligation, it was allowed to retest, means to move up to retest 32,880 or around 32,880. So yesterday the Dow Jones has changed, and now the Dow Jones is like 70% or 75% bearish. 75% bearish. But the most important part in the Dow Jones is that the Dow Jones is still trading below the moving averages, closing below the moving averages, and there is a clear bearish fan out in the moving averages. On this particular day, the Dow Jones tried to close or tried to give this the bullish crossover to the moving averages. It failed. Okay, it formed a slip. Bearish slip. And I informed my community member that see, there is a bearish slip, means the Dow Jones is going to fall. And then a fall and a fall, it came down. So now this thing is because of these the moving averages, the Dow Jones is bearish. And because now we see that in order to give a bullish crossover in the moving averages, Dow Jones need to move up heavily, like 2 or 3 more candles. Okay, but because the possible depth default is in the picture, this means that there is a very, very heavy risk that if it moves up like for 2 or 3 days, okay, there is a very, very heavy risk. But if it try to move up, and again this kind of situation is seen that if the Dow Jones fails and if there comes another slip, then the Dow Jones will fall heavily, very heavily. Okay, and the same will be seen in the S&P 500, right? That is why, because the Dow Jones is now 75% bearish, is still 75% bearish, that is why even though the S&P 500 is 100% bullish or absolute bullish on the daily as well as on the weekly chart, the upward movement of the S&P 500 will still means it will still not be very heavy or very high. Okay, upward movement will be little normal or it will be restricted. I'm not saying that there cannot be any upward movement in the Dow Jones. Sorry, not in this the S&P 500. There can be there can be this the upward movement in the S&P 500, but because of the bearish Dow Jones, the upward movement in the S&P 500 is expected to be limited, normal or constrained, right? Clear? So now I hope all of these the factors are clear to you, and now you understand that how these factors can affect or impact the movement of the S&P 500, okay, in the coming week, right? Now probable movement, if you notice that finally on the weekly chart, S&P 500 was able to close above 4195. What was 4195? It was the high of the year, high of this year 2023. Okay, now the S&P 500 has closed above 4195, right? And also it has closed below 4207. It tried to move up, it struggled 1, 2 or 3 times. Okay, it struggled to clear that 4207, but it failed. Okay, this means that on Monday, because there are these the bullish sentiments, okay, but the only problem is that there is a long weekend. Okay, Monday is the holiday. So if there comes no news, okay, and everything remains neutral, in that case on Tuesday, because of the bullishness, we can expect some bullish movement initially, or kind of bullish open, like a gap up open, gap up open, or irrespective of any open, a bullish movement on initially upon open. Now if there comes a open above 4207, or if there comes a open below 4207, but initially within 1 minute or within 5 minutes, if it is able to clear the 4207 and sustains above 4207, in that case what will happen? In that case there will be some good chances that the S&P 500 can move up to this, the 4227, or move towards 4227. Now at the same time the Dow Jones will be where? At the same time the Dow Jones will be, or the Dow Jones will have to struggle around these the moving averages, okay, and then it will try to come towards this the Chimo cloud, but before that it has these the 2 or 3 moving averages, okay. So if the Dow Jones struggles to clear the moving averages, it means it moves up, but if it struggles to clear the moving averages, in that case the S&P 500 will be able to move up a max up to this, okay, 4227 or around 4227, and that's it, right? Now if everything goes well on Monday, if the Dow Jones is able to hold and sustain above, okay, this thing, this the 4207, okay, or if it closes around 4227, okay, then on Wednesday, okay, it can further try to move up. But now there is a problem. That problem will come into the picture on Tuesday itself. The problem is the debt ceiling or the debt default, okay. If there comes no news by Tuesday, in that case more fear, more panic, okay, more uncertainty, right, that will be there, and there will be very heavy volatility in the entire US stock market, okay. In that case, if they know that when exactly this thing is going to happen, these are market manipulators, okay, and if they think, okay, that they can further push it, okay, this in this the bull side, in that case what will happen? In that case the S&P 500 can move towards 4265 or 4260, okay. But again, any movement, any logical or illogical movement, any technical or any non-technical or manipulated movement will be at most up to 4300. But for now even 4300 is not in the picture, rather we are focusing on the 4227, okay. So if there comes no news on this the debt default, or if there comes some news, some positive news, okay, that on this the debt default on Tuesday, okay, and it looks like that yes, a possible, okay, means the US is not going to default on its debt, in that case on Wednesday also the S&P 500 can try to move up, or it can move up, simple, right? If the situation remains same, in that case Thursday also, okay. But when Tuesday it moves up, okay, and also on Wednesday when it moves up, then in that case it will become saturated, okay, on the lower level charts of the okay itself, this is the S&P 500, okay. In that case either on Wednesday or on Thursday it will have to hold, okay, or to give something like this kind of movement, or this kind of movement, okay, small green or red kind of candle, okay, small movement either on Tuesday or or either on Wednesday or on Thursday, right? Now comes the Friday will be June 2nd, okay. Now the movement of the S&P 500 on June 2nd, that will be Friday, if there comes no news, no confirmation, then this the bullish movement, all of a sudden the bullish movement can turn into a heavy bearish movement on Friday. Why that will happen? Because then there will be June 3rd Saturday, June 4th Sunday, okay. And yesterday there was a news, I'm not sure whether that news can be trusted or not, that the Treasury Secretary is saying that they have the funds, okay, to fulfill the obligation until June 5th. In that case no one would like to take the chances that what is going to happen, okay, this by next weekend. In that case they will try to dump on Friday itself, okay, clear? Now the thing is that if there comes, let's say on Tuesday it moves up, okay, and Tuesday, okay, there comes some news about the debt ceiling, or if there comes more fear, okay, and also at that time it is trading around 4227, and at the same time the Dow Jones is also struggling, okay, around these the moving averages. That will further confirm, okay, this the fear or this the panic, okay, and in that case the upward movement will be restricted, and then either on Tuesday or on the Wednesday itself the S&P 500 will further come down, right? But as long as the S&P 500 is holding and sustaining above 4155, remember what? 4155. As long as the S&P 500 is holding and sustaining above 4155, it can still give a bullish reversal. But as of now, any fall, any immediate fall will be limited to at first 4185. We have 4185. A breach of 4185 means 4155. And this fall can be seen on Tuesday itself. Okay, provided that there comes a condition where the open is less than or open is below 4185. If the open of the S&P 500 is below 4185 on Tuesday itself, in that case the S&P 500 has to struggle in order to move up. Okay, first 4185, then 4195, etc., and then because it will struggle, and at the same time the Dow Jones will also struggle, means in that case there are good chances that it will give up, and again it will come down to 4155. If it comes down, closes below 4155, means further fall. Further fall means this time towards here. Okay, this time towards up to what? This time towards up to 4091. Okay, and then 4065, and then finally the 200-day EMA. 200-day EMA. Okay, it is around again the same zone, 4035. Okay, the zone of 4035 is from 4045. Sorry, 4025 through 4045, right? So this will be okay. So this will be the picture if there comes a open that is less than 4185 on Tuesday itself. But if there comes a bullish movement on Tuesday, and if it is able to hold, but on Wednesday if there comes, you know, a open that is less than 4185, then again the same condition. Okay, this is the same thing. The only thing that can simply, you know, ruin this the setup, or each and every kind of setup, is that if there comes a news that now most likely the US is going to default on its debt. Okay, when that happens, then what will happen? In that case, within a day, very heavy fall, within a day, 5%, 4 to 5%, or even 7% fall within one day. That will be there, right? That is why I have advised this to the people, okay, who are trading the short term, intraday or short term, that if you are bullish, then see, there is no harm in going bullish. Okay, and it is not bad that if you are going bullish. Okay, if there is an opportunity, then grab it, whether it is bullish or bearish. Whether it is bullish or bearish doesn't matter. It's an opportunity. Opportunity is an opportunity. Grab it. But in this particular case, because the stock market is getting more and more volatile, that is why you are advised to cover your trades, okay, or to use the stop loss. Okay, but for the people who are trading in this the long term, like 1 year or so, okay, and they are planning, okay, everything for this the recession, you need not to worry about, okay, these the fluctuations, okay, or these the things. Just keep on collecting the shorts, okay, or these the put options. Okay, that's it. You need not to fear, or you need not to worry about anything else. Okay, now this is the thing. So if there comes a news, okay, that the US is most likely is going to default, okay, in that case, if the news comes on Tuesday, then a heavy fall on Tuesday. Wednesday, then a heavy fall on Wednesday, okay, or Thursday. It will depend, okay, on these days. If there comes no news, no neutral or nothing confirmation by Friday, then on Friday itself, what we have seen, okay, on this the last Friday, a heavy bullish the movement. Okay, so next Friday what we will see? Heavy bearish movement. Okay, that will be there, because if there comes no news or no confirmed news on this the debt default, right? And guys, one more thing that you must remember, that the next week, okay, it is getting more and more volatile. Okay, every day will increase additional volatility to the stock market, and you must be ready to see the surprises. Okay, not just to see, but you must be ready to accept the surprises. You will see that it is moving up, all of a sudden a fall. You will see that it is coming down, all of a sudden, okay, a bullish movement, right? So there will be this kind of movement. Okay, but if you are my community member, my Patreon community member, then you need not to worry about this, because just like, okay, there's the fall, the reversal, then a bullish movement. Okay, so we will capture. Now this the Dow Jones. Okay, it moves up, it struggles. Okay, then it comes down. As soon as Dow Jones closes below 32,880, whether it's Tuesday, Wednesday, Thursday, doesn't matter. As soon as Dow Jones closes below 32,880, it will fall. It will fall. It will come down. And because this bullish candle has made more than enough room in the bearish side, this means a fall up to 10%, 12% can be easily adjusted, or in simple words, it will be acceptable, right? So means you will be trading in the S&P 500, okay, or in the Nasdaq, okay, but you should also look into the Dow Jones, okay, and particularly what? Look in the Dow Jones, particularly the closing below 32,880. This is the mark. Closing below 32,880 means now it is going bearish. Plan your trades accordingly. Leave your bull trades, enter bearish, or cover your bull trades. Okay, means whatever you want to plan. Okay, so you can plan accordingly. But this will be very, very important, because see, remember, when the Dow Jones goes bearish, this means that the stock market is going bearish. We will not say that the Dow Jones is going bearish. We will simply say that the stock market is going bearish. So this thing is clear, the Dow Jones. Okay, now in the S&P 500, what you must remember, okay, this is 4155. Yes, okay, 4155. Just like, okay, so as soon as the S&P 500 closes below 4155, just be ready. And at the same time, if the S&P 500 closes below 4155, and at the same time if the Dow Jones closes below 32,880, then like very likely, highly likely, 100%, okay, there will be a fall. Open will be the high. This kind of situation, okay, it can be seen in the stock market. Okay, in this particular case, only the manipulation or some news can help or can change, otherwise no. Otherwise this will happen, and this is how it is going to happen, okay, in this particular case, right? And guys, there is one more thing. Okay, if you think that that the Dow Jones, okay, there was a very heavy fall, like 2% fall within a day. Dow Jones has closed below this, the 32,880, right? Now you might be thinking that, okay, it is like technically, okay, or through some other reasons, okay, or through your assumption that, okay, now the next day the Dow Jones is going to retrace, or the S&P 500 is going to retrace. No, that is not necessary. It has given 2% fall in one day. Next day again there might come a gap down open, and then again another 2% fall, then another 2% fall. Okay, there is no rule, there is no such rule that if an index, okay, it is coming down on 1 day or 2 days or 3 days, then it will hold. No, until and unless some very strong technical condition is seen that it has simply overshoot the technicals or saturated, we will not see a reversal, rather back to back that kind of fall, or similarly, okay, back to back that kind of bullish movement. And guys, there is one more thing, particularly if you are trading in the short term or intraday, that you need to change your strategy every other day, particularly in the next week, because next week will be very heavily volatile. There will be very high volatility, and means under under such circumstances, okay, or whenever we have seen, okay, this kind of situation, then things can change, okay, in the blink of an eye. That is why if you are trading intraday, or if you are trading in the very short term, then you must look, or you must observe, and you must trade, or you must make changes to your trades on the day by day basis. For example, if on Tuesday, if the S&P 500 closes above 4195 or 4207, then looks like that it can go bullish. Yes, technically next day it should move up, but if there comes some news, then the next day there will be a gap down open and a heavy fall. Okay, and even if there comes no news, but because the volatility will be high, okay, if there comes a open that is below 4185, then again, okay, fall, even though it was technically it was supposed to move up, but now it is coming down, right? That is why I am saying, particularly for the short term traders, for the intraday traders, you need to change your strategies every other day, and you need to trade accordingly. Now, in order to sum up, 4155 very first strong support, 4110, another very strong support. 4035, very strong support. Okay, after 4035, then you will see the support around from 3937 to 3907. Then the next support will be seen at 3840, 3790, and then there is 3000, 3630, I guess. Okay, that is the very heavy support. Okay, and a fall from 4200 to 3630. Okay, within a week can happen. Yes, it can happen, only and only if there comes a confirmation that the US is going to default. Else a fall of this 600 points will not be there. Right? Clear? Okay, but yes, even in the normal cases or even in the normal scenario, a fall up to 4000, yes, that can be seen. Okay, that's not a problem. That can be seen. And if you want to join my Patreon community, then I've given the link in the description of the video and also in the comment section. So guys, if you have not yet subscribed to my YouTube channel, then please subscribe to my YouTube channel and hit the bell icon. So this was my S&P 500 weekly technical analysis. That is from May 30th, which is Tuesday, through June 2nd, that will be Friday.